As we sit here on this Sunday afternoon, November 30th, the markets are currently closed, giving us a crucial moment to pause and dissect the chaotic end to the trading week we just witnessed. Datavault AI, trading under the ticker symbol DVLT on the Nasdaq, closed the last active trading session on Friday at exactly $2.03. We saw a decline of roughly 4.7% during that session, with the stock oscillating between an intraday low of $1.94 and a high of $2.24. It is vital to understand that while the market is sleeping right now, the narrative around this company is wide awake and moving at a velocity that frankly makes traditional blue-chip analysis look like it is moving in slow motion. When you look at the after-hours data, we saw a slight additional slip, but the headline figure you need to lock into your mind is that $2.03 close. This is not just a number. It is a battleground line drawn in the sand by bulls who are looking at the company's massive pivot into Bitcoin and data tokenization, and bears who are skeptical of the micro-cap volatility. The expectation right now, what most retail investors and those casually scrolling through Robinhood or their SoFi active investing dashboards believe, is that Datavault AI is simply another speculative, low-float penny stock trying to ride the coattails of the artificial intelligence hype cycle. The general sentiment on the street, if you look at the message boards and the chatter on Interactive Brokers trading forums, is that this is a pump play, a company throwing buzzwords like Web 3.0 and blockchain into a blender to see what sticks. They see a company with a market cap under $600 million and assume it is just noise in a system dominated by giants. That is the expectation, a fleeting moment of volatility that will vanish as soon as the liquidity dries up. But here is the reality, and this is where we need to lean in closer, because the situation is far more complex and potentially far more consequential than a simple meme stock rally. The reality is that Datavault AI is attempting to execute one of the most aggressive structural pivots we have seen in the small cap space in years. They are not just selling software, they are attempting to financialize the very fabric of data itself, backed by a hard asset treasury strategy that mimics the early moves of companies that are now worth hundreds of billions of dollars. We are looking at a company that just closed a massive tranche of Bitcoin financing, holding over 1,200 Bitcoin, effectively turning their balance sheet into a hybrid of an operating technology company and a digital asset vault. This isn't just a software play, it is a leveraged bet on the convergence of the data economy and the crypto economy. And if their platform for tokenizing real-world assets gains traction, that $2 share price might be looked back upon as a distinct mispricing of potential. The gap between penny stock hype and structural data infrastructure play is the opportunity we're analyzing today. Let's look at the recent movement, because the chart tells a story of extreme accumulation and violent distribution. Over the last quarter, we have seen DVLT explode upward, registering gains that, percentage-wise, rival what we saw in the early days of Tesla stock or the most aggressive moves in Nvidia stock. We are talking about a stock that was trading at 25 cents, quarters, literally, earlier this year, now fighting to hold the $2 level. That is a massive multiple expansion. On Friday, despite the wider market liquidity being somewhat thin due to the holiday hangover, we saw over 23 million shares change hands. That is not retail noise, that is institutional rotation and high-frequency algorithm engagement. When you see volume that high on a stock of this size, it tells you that the liquidity pools are deepening. It means that while you might use Fidelity Investments or Schwab Intelligent Portfolios for your safe, long-term holds, the speculative capital of the market is flowing like a river into DVLT. The volatility we saw on Friday, dropping nearly 5%, is standard for a stock that has run this hot. It's a cooling-off flush, shaking out the weak hands who bought the top, while long-term believers in the data tokenization thesis likely used the dip to accumulate. To understand why this is happening, we have to look at the broader sector momentum. We are currently in a market environment where real-world assets, or RWA, is becoming the dominant theme for 2026. You have the titans of industry, the BlackRocks and the Franklins of the world, talking about tokenizing everything from treasury bills to real estate. Datavault sits right in this slipstream. Their recent news regarding the partnership with Scilex Holding Company is a prime example of this. This isn't just a press release, it's a strategic alignment where Datavault is providing the data infrastructure for a biotech exchange. They're essentially saying, we will take your valuable clinical data, your research, your intellectual property, and we will turn it into a tradable, trackable, monetizable digital asset. In a world where data is often called the new oil, Datavault is trying to build the pipelines and the barrels. Most people using a fidelity trading platform or browsing investing sites for ideas often overlook the mechanics of these deals. The Scilex deal involves significant milestone payments and a licensing fee structure that could bring actual cash flow, the lifeblood of any small cap, into the company. This moves the needle from concept stock to revenue-generating entity. Furthermore, the company's decision to hold a significant Bitcoin treasury is a signal. It signals to the market that they are aligning themselves with the hard money crowd. It acts as a hedge. If the dollar weakens, or if inflation takes up again, their balance sheet assets appreciate. It is a strategy that creates a floor, or at least a psychological floor, for investors who view Bitcoin as the reserve asset of the future. It creates a reflexivity loop. As Bitcoin rises, Datavault's book value rises, which theoretically should lift the stock price, allowing them to raise more capital to buy more assets or build better tech. It's a dangerous game if it reverses, but in a bull market, it's rocket fuel. Now let's strip away the hype and look at the business model itself. What does Datavault AI actually do? At its core, they are a technology company focused on data monetization. They have a patented platform, often referred to in their filings, that helps entities identify the value of their data and then monetize it securely. Think about how much data is wasted every day. Healthcare records that sit in silos, consumer behavior data that isn't utilized, supply chain information that disappears. Datavault's pitch is that they can vault this data, secure it using blockchain technology, and then allow the owner to sell access to it or tokenize it without losing control. It's similar to how Snowflake stores data, but with a layer of financialization on top. They also have an arm focused on acoustic intelligence and other niche tech sectors, but the main driver here is the ADO platform and the data exchange capabilities. When you're considering online investing or looking for investment help, you are often told to look for a moat, a competitive advantage. Datavault's moat, they argue, is their intellectual property portfolio. They have spent years accumulating patents on how to track and monetize data objects. In an era where AI models, like the ones powering the Schwab Intelligent Portfolios algorithms or the recommendation engines on Robinhood stock trading apps, need massive amounts of clean, verified data, a company that verifies the provenance or origin of data becomes critical. If you are training an AI, you need to know where the data came from and that you have the right to use it. Datavault solves this provenance problem. They create a digital fingerprint for data assets. This is why the biotech angle is so interesting. In biotech, data integrity is everything. If Datavault can become the standard for securing and trading clinical trial data, the valuation implied by that utility is multiples higher than where we are today. However, we must address the risks because we are professionals here, not cheerleaders. The reality of a microcap stock is that it is subject to extreme manipulation and liquidity crunches. Unlike Apple stock or Tesla stock, where you have trillions of dollars of liquidity, a stock like DVLT can move 20% on a single large order. There's also the dilution risk. Small companies need cash to grow. Often they raise this cash by selling more shares, which dilutes existing shareholders. We saw this with the recent financing tranches. While the financing brought in Bitcoin and capital, it also involves warrants and potential future share issuance. If you're using a Fidelity brokerage account or Interactive Brokers stock trading setup, you need to be aware of the fully diluted share count, not just the basic float. You have to ask yourself, is the growth in value faster than the growth in share count? So far, the market seems to think so, given the price appreciation over the year, but it is a constant tightrope walk. Let's shift gears to the macroeconomic picture and how it affects a company like this. We are currently in a fascinating window where interest rates are stabilizing and risk appetite is returning to the market. When rates were high, nobody wanted to touch a speculative data company losing money. Cash was king. But now, as we look toward 2026, the hunt for alpha, for returns that beat the S&P 500, is back on. Investors are bored with the slow compounding of Fidelity mutual funds or standard Fidelity ETFs. They are looking for the next SoFi or the next breakout tech star. This risk-on environment is the tide that lifts boats like Datavault. Furthermore, the regulatory environment around crypto and tokenization is becoming clearer. If the government passes legislation that favors the creation of digital asset exchanges, which many analysts predict is